Hutchford. I am a member of the corporate law group here at Squire Patton Boggs. You are sitting in the main meeting room of a legal firm. Therefore, you are bound to hear a bunch of stuff about law firms and like legal services. So I apologize for that. For those of you who do not know, Squire Patton Boggs is a very large global law firm that has its tentacles in virtually every sector, every industry, every area that you are, including the area that we're talking about now, which is capital fundraising on the capital markets. It's fun whenever you do schedule a theme for a conference. Whenever you're talking about raising money, somehow the place is full. I don't know why. I don't know how that happens, but it is. And so I'm glad to see so many people here. We have an excellent panel set up for you. Our friends at U.S. Capital Partners have put together a very good. It's 3 lessons. Why are there always 3 lessons?
It's a good number.
Are there only 3? Are there more than 3? 3 is a magic number.
Well, you learn 3 ways.
3 is a magic number.
You learn 3 ways. You either learn by hearing, seeing, or experiencing.
Did you just come up with that right now?
Or 3 times the charm.
That's good. I like it. But I will leave it to our co-host, Vanessa Guajardo from U.S. Capital, to introduce the individual panel members.
Yeah.
But for those of you who do want to come, do have questions or thoughts or things that you aren't able to ask during the panel discussion, we'll be around after. Come and talk to us, come and ask us, and we'll be there. So Vanessa, take it away.
Cool. Thank you. All right, well, thank you all for coming tonight. We have a great turnout. I'd like to present the U.S. Capital team. We've provided asset management and corporate finance services to our clients for over 20 years now, serving our clients from the majority of the globe's financial centers. Our company motto is do well by doing good. And what that means is that we are committed to socially responsible investing and positive social impact. Small and lower middle market businesses are renowned as the engine of positive creation and economic development. Beyond job creation and expanding the economic activity, we are committed to our core values of diversity and positive social and environmental impact. So tonight's door fee will be donated to the San Francisco Food Bank. And with that being said, I'd like to introduce our speakers. We have Charles Sell from U.S. Capital Global.
Senior partner,
managing partner. We have Jeff Sweeney, our CEO and chairman.
chief cook and bottle washer.
Yes. Haydar Habib, managing partner of Andre Capital. And David Salzman, principal at Squire Patton Boggs. So give them all a hand. And we'll let Jeff take it away.
So we have lawyers, bankers, and client, otherwise known as victim. Well, U.S. Capital, I mean, we're a licensed broker-dealer, asset manager, fund manager, things of that nature. We've been at it a long time. I don't know why we're not richer, but we'll get there. We'll get there. And then we've got one of our clients here, Haydar, has a, we'll use him as an example of kind of a fundraising activity and using a kind of a token-based or a digital security platform, which we're going to talk about extensively tonight. And then we've got Dave here, who's counsel, done a lot of fund work. So that's what we've assembled. So the bankers, the lawyer, and the client. So we cover all the bases here. Let's talk about. Shall we start? What do you want to start with?
Spotify, or you want to go into?
Oh, we're going to talk about Spotify. Yeah, okay, that's what we're going to. So
it's in
so
the
we,
title.
It's in the title. That's right. So the goal is to be entertaining here, and so Spotify. We talked about Spotify because that's a pretty good example of a company that had a real business model, had an ethical business model. They wanted to pay. We all know Spotify, right? The music serving guys. They had
not Napster.
I'm going to get to that. But they had an ethical business model, right? They wanted to do music sharing on a subscription basis so they could pay the artist as opposed to Napster. So, of course, Spotify went public and Napster went to jail. But I like. But anyway, the important thing is they had a decent ethical business model that had the potential to make money, right? And so they're a pretty good poster child of how to move through the capital markets and actually go onto the public market. And we're going to focus on the secondary sales of their private securities a little bit, because that ties into kind of a more contemporary way of dealing with secondaries in a kind of a tokenized security way. So again, Spotify, ethical business model, decent business model, you know, early rounds, angel rounds, and then they had secondary growth rounds and things like that. And they grew their subscribers, they almost made money. And then they had a very active secondary market, right, in their securities, very active. Spotify was really active in secondaries. But secondaries for these private companies today are an awkward beast, right? You either get, you know, you've got some venture fund disgorging or trying to create some liquidity. It's really awkward construction. You're in some SPV. The venture guys are trying to clip coupons off the SPV, management fees and carry, and then you have to buy into that. Usually it's large blocks, you know, minimum 5 million usually to be in any kind of structure that makes sense. If it's smaller, it's even more awkward and risky, counterparty risk, especially if you're in some facility that the shipping clerk is in and his estate may challenge you can get counterparty insurance for that, but it's an awkward structure. But Spotify was really successful in that awkward structure. They had large investors, and they had a very active secondary market, and then they had, of course, they moved to the public arena. They didn't actually raise any additional capital. They just created liquidity for all their investors and created a retail liquidity product. So interesting, good business model, angel round, growth round, active secondary market, public launch, right? Pretty cool. So what we have now, what we're seeing now in the marketplace is with a kind of a tokenized or a blockchain tokenized security, there's the opportunity to make this secondary, this private secondary and even the primary market more efficient, right? And that is kind of the beauty, I think, of this particular sector in this kind of emerging technology, is to make that secondary and primary issuance more efficient, less transaction costs, safer to deal with, less counterparty risk, and like that. And this is why I use Spotify as the example. It's that section there where they dealt with it very well, awkwardly. I think we can inject some newer technology into that piece of it and help the investing community and the companies in the capital raising. So that's kind of the gist of the thesis here. And then you get into blockchain, and, you know, as a way ledgers, and you get into tokenized, you know, electronic securities instead of paper. Well, and Dave can talk about that. Instead of paper securities with a Excel spreadsheet in the attorney's office keeping track of what shares are owned by whom, you have the opportunity to do that a little more digitally, which is a little more efficient. So I don't know. So that's kind of the thesis. That entails the design. That means the original security offerings have to be a little bit digitally compliant, right? So that means you have to think a little further about if we're going to have a wide distribution of securities that are going to trade digitally, how much voting rights do you want them to have, right? You're going to have a pref, non-trading group, and then you're going to have a common trading group that has lower voting rights, so you don't have problems with concentrated voting and things like that, right? So it takes a little bit, and then you have to design the securities, at least the initial stock, in a way that's kind of thinking in terms of secondary market and digital trading. So it does involve what we call reg tech, right? So you have to think it through a little bit more thoroughly on the front side, because you have all these, you know, unicorns like Uber, Airbnb. We sell secondaries, right? U.S. Capital does sell secondaries, and so I know how awkward those structures are. And those companies figured they were going to go public. The gestation period for public is much longer now, and they never anticipated a secondary market, and so none of their securities anticipate a secondary market, hence you have the awkwardness, right? So if we're thinking today, where the market is today, so as you're thinking about a launch, you know, to raise capital for your company or another round, you want to think in terms of RegTech and, well, how does this really fit into a more electronic private securities marketplace? And you want to think that through a little bit. And
Because that's secondary for Spotify. There was a lot of coverage under NDA. There were a lot of insiders, investment banks, professionals, accountants that were covering that company prior to its listing.
Giving valuation opinions.
Which validated its increased value. There was a lot of coverage. That was key. That
Yeah.
was that secondary market for the last 2-3 years that Spotify was engaged in. There was a lot of coverage as a result of that that trading that occurred. And that coverage,
Was there a broker behind that process, or was it the company itself? Or how did-
bankers, they had bankers.
bankers were trading the blocks. There are established alternative trading systems, that ATSs that are broker dealer registered with FINRA.
Even a private stock, right?
Yeah.
Yeah,
But brokers, I mean, investment bankers, we can sell private securities and facilitate secondary sales.
So is that one of the things that the U.S. does in regards to?
Sure.
Yeah.
Absolutely. Well, I think this is also a pitch. I mean, look, you need 3 legs of the stool. You need the issuer, you need the attorneys, you need to bring the bankers in, because if you notice, ICO. If you notice,
the
ICOs.
product is the issuer.
The
product's
issuer, that's the product.
The issuer is responsible for
But
the product.
I want you to take note, there's not very many broker dealers that got caught up in this ICO debacle, right? Because we wouldn't touch that stuff. We knew it was toxic, right? And then now all the subpoenas are out, and now a lot of the attorneys are making a lot of money trying to unwind these ICOs and keep these guys out of trouble. Now, when you look at blockchain tokenized securities, now the bankers will come in. This is a security. It's an electronic security. It has all the same. The SEC is okay with it. So now you'll see that bankers like us are willing to deal in this, while we wouldn't touch an ICO.
Let me add to that. We're entering the third wave, what I call the white wave of the blockchain. If you look at, initially it was very black. It's all about bypassing the financial systems. And then we entered into the gray wave, which is a lot of these ICOs, no compliance, no registration. They're trying to treat it like a utility. And that is not going to last, because majority of them, over 90%, will
The
fail
technical
with
banking expression
That's
is
right.
that market is blown up.
It's blown up. And now we're entering into fully legitimate, security tokens that are backed by assets, not backed by scarcity like what you see with Bitcoin and others, backed by real assets, dollar for dollar, and they're very well governed, very well, managed, very well lawyered, with the attorneys, and the shift to this kind of what I call legitimate coins or a growth coins is going to happen. We're starting with that, and this is one of the things we're doing here at Andra Capital, with the help of Jeff and other firms.
Is there a regulatory compliance though in regards? to
Absolutely.
Basic securities law.
The same security laws exist on the books today. You have to be compliant with it, not only in the U.S., but across the globe. And the nice thing about it, you can build all of that in your digital token into the blockchain itself, where you can have the legal language for each country fully embedded in your coin, so you can trade it between the globe without having to have somebody from compliance spanking your hand saying, hey, this is illegal. So can be fully seamless, cross borders, and typically if you look at it I used to be one of the founder CEOs of a unicorn company. It takes 90 days to transfer my shares to anyone else. It takes $30,000 minimum, and bunch of rovers. You guys.
We love that.
Yeah, of course, attorneys love that. Well, on the blockchain, you can do it in a matter of seconds across the globe, and there is, you have full paperwork, built in your blockchain, and this is very revolutionary. You're going to see this big change into the security tokens over the next few years.
So it reduces the friction in the transaction.
That's right.
Where
still-
the
go ahead.
issuers have gotten into trouble is when they don't consider their tokens to be securities.
Exactly.
Some are and some aren't. And a lot of the issuers do things without really fully consulting the lawyers or lawyers who know what they're talking about. And when they issue tokens that are securities, but they don't comply with securities laws, obviously that's when the problems start. And the SEC is only really just starting to get into this. You know, it only just really recently started its cybersecurity division.
Yep.
And if you guys remember back in the heyday of the dot-com boom, there were all these problems with these startups offering stock online, sometimes for free even. And you know, that was how many years ago when the SEC didn't have any division focusing on stuff like that back then. Now they're finally getting into technology, if you will, but it's kind of lagging, I think.
So, David, so basically, issuers should replace the term token with security when they're reading security laws. They should replace the term promoter with banker
Yes.
when they're hiring promoters. And then they should replace their general counsel with a securities attorney.
Or with me.
I mean,
Yeah. No, that's absolutely right. And, you know, the devil's always in the details. You know, many lawyers were anal because details really do matter, and the terminology does matter as well. And whether it's a security or not, you know, it's best to discuss it. If it is a security, call it a security.
That's right.
And I know I'm pitching, because I'm a banker, I'm pitching the bank end of it. But you got to think, look, we have to sell these things, right? Because a lot of our duty was distribution. So it's important to collaboratively work with the issuer and the attorneys to come up with a product that we can sell.
That's right.
Because if everybody's working in a trench somewhere and they come up with this PPM and I just go, you know, the guys aren't going to buy this. You know, so we have to work together to design a product that not only is compliant, but also meets investor needs and interests. So that's why it's better to have
That's
a
no
collaboration.
different than doing an IPO. And so I'm really confused in regards to it being at a level below an IPO, which is what you're talking about. Is that correct, or am I here?
Well, the reason it's below a level of IPO is generally the sales are restricted to accredited investors.
That's right.
Or,
As
or
qualified
purchase.
purchasers as opposed to a retail product. So when you say IPO, it's retail.
Yeah, I
And that's the
The
differentiation.
bar is higher for IPO. I mean,
So,
Yeah.
so when you're really talking about these digital securities, you're really thinking in terms of a private market or a private stock market for accredited investors, not
Yeah.
retail investors.
so
No different than an angel investor.
Similar in some sense, but some of these are late stage companies. They're not angel level.
Their valuations
Yeah.
are higher than a lot of the mid-market
Like a-
public companies.
You can establish valuation by whoever somebody will pay.
Well,
and,
sometimes,
that's why there's a
Sure.
secondary market of
or the market
of
cap.
qualified institutional buyers bidding based on a valuation,
Well-
just like SoftBank
yeah. So
on
let-
Uber.
Let me add to that because again, from my experience, the valuation is based on three things: how much revenue you're doing today, what's your trajectory of growth, and also market comps, right? Which is valuation of existing.
There
There's
is no
a-
market cap.
And actually, there
The
is.
market cap is set by the
Actually,
bank.
Comp,
there is.
market
there is
comp.
Market comp. Yeah.
Comp.
Yeah,
Comp.
comp. There are companies and accountants, specifically in Silicon Valley, that like Duff and Phillips. They do 65% of all private company valuation. These are valuations that are very consistent. We used to do it for our 409 for our employees. We do it every quarter, and this is how we can, we give shares to our employees. So the valuation is set, and every VC-backed company will have valuation. And the closer you get to IPO, the convergence between common and preferred will happen, and you can see more market value then. But they are actually valued specifically by the top accounting firms today, and these valuations are very accurate and reflected both in the secondary market and the primary market.
Oh,
Yeah.
Blockchain assets, right, that come to the market as a security,
Yes.
and they become like utility,
That's
right?
right.
And they have not duality, I would call it multiple. They could become a stable coin. They could have many layers, right? So when you're selling to your investors as an equity, it becomes a stable currency that most utilities are trying to do to make like Stellar. What are you going to tell your investors that, well, it's going to stable at some point, you're not going to expect the returns in 5 years or 10 years. At that point in time, like, what would that situation be?
I mean, I'm happy to take that question. I'm true believer in the separation between utility and security. There is a very fine definition of which one is which.
The SEC has a definition.
Exactly, and I'm totally in agreement with the SEC
Well,
chairman.
a coin, a
Yeah.
utility coin's a commodity,
Yeah.
and a security coin is a security. So they
Yeah.
define it.
But let me answer your question a little bit in more detail. I am not a believer in a pegged coin to, let's say, US dollar to create some kind of stability. I'm a true believer in what we call growth coins. A coin that is backed by real assets that are growing instead of depreciating, like pegging it to currency. Like tech companies into their growth mode, or real estate, iconic assets that are growing consistently at 10% a year. You know, these are the coins that you're going to see in the future, and we're going to call them growth coins, and they're 100% backed by assets.
So, hey, look, this is a good point to introduce. So the victim here, Hadar, our client.
And the technology.
So he and the technology. So anyway, so let's deconstruct his issuance. Okay, let's talk about what he's doing. So he's got we've constructed a Cayman Island limited partnership. The investment thesis for this Cayman Island limited partnership are Silicon Valley growth companies of roughly $500 million market cap, right? With a growth trajectory and what's the other word is dominant in their vertical, right? So he's building a portfolio. So it's an investment fund, a portfolio of companies like that.
So traditional investment.
Traditional investment fund. It's an LP structure. The investors have to be qualified purchasers, so they must have at least $5 million of investable assets. We can have a limited number of limited partners. It's located in the Caymans, so we can easily have foreign investors, and their distributions are not withheld by the U.S. government, right? Okay, so that's interesting. Nice asset class, vanilla fund. What does that have to do with tech? Aside from that's the investment thesis. Well, the interesting thing about it, and there's a lot of people that are interested just in that asset class and can invest and sign a subscription agreement and be an LP, right? Now, what's interesting about it is one of those LP units is purchased by a British Virgin Islands company, because the BVI is a great token venue. Right?
Issuer, yeah.
So one of those LP units is purchased by a BVI company. That BVI company acts as a trust for that unit and fractionalizes it into tokens, right? So that way there's a section of that that's electronic. So you can either buy a conventional LP unit, or you can allocate some to a tokenizer electronic. So you have all the economic benefits flow down to the token. So that way it's a hybrid that doesn't interfere with either investor, but it does create a possibility of liquidity there. And now you have a coin that's backed by an asset, right? And that asset actually has a daily NAV, a net asset value, by Deloitte. So when you look at the token, well, I've got I own a third of this LP unit or whatever it is, or one unit, and you can see that, well, you can know what it's worth.
Yeah.
You know what it's worth because you can see the NAV.
That's right.
Right, as opposed to, a utility coin, which is a little based on volatility and trading and demand. This thing actually has a base asset value. And to me, that is a type of tokenized security that is going to become more prevalent as an asset-backed security. It'll become more prevalent along with the coin type things, the commodity type currency, as well as these asset-backed. And there'll be a number of asset classes that will have tokens like that.
Yep.
And the market's going to need that because you articulate. He coached me on all this stuff. But you think about now, if you're on Coinbase, right, and you've got your Ethereum and you've got your Bitcoin like that. And Bitcoin's getting hammered. What do? You can go to one of those currency-backed coins, or you could move over for safety because, well, I'm going to go to the Silicon Valley coin because that's backed by a NAV. So I'm going to let the volatility settle down, and I'm going to move my assets over here for a bit. And then when Bitcoin starts coming up, I might cash that in and go into that and take it up. So it's going to facilitate some, an active market in there, and you'll see these alternative trading systems, these electronic platforms, have more and more asset-backed securities there, asset-backed coins. That will happen just like the stock market, but it's for accredited investors, just like the stock market. Stock market starts to get volatile, rush to treasuries, right? Everybody goes to treasuries. And then all of a sudden the market stabilizes, starts going up, you sell the treasuries, and you go back into the marketplace. This will happen this is the private security marketplace that I'm talking about. This will happen.
Yep.
It will happen. And it'll happen with securities-based, banker-run, lawyered-up stuff.
Well audited, well governed.
Right.
You know.
Well, there's probably
Transparent.
there's probably more assets in the private equities than there are in the public.
There's $400 trillion worth of private assets in the world that is completely illiquid, completely inaccessible, and if you're a small investor, you have no chance in getting in this. For example, the Silicon Valley companies we're talking about, it's a $1 trillion asset class just between here and some of the companies coming in China. If you don't have a check of between 300 million to get into Tier 1 BC to access this asset class and stomach to wait for 10 years period, you will have no chance in getting in these asset classes. Here with the blockchain, you can create some kind of liquidity where you don't have to wait 10 years and be able to access them anywhere in the world. You don't have to be an investor in Silicon Valley or in a big fund or what I call the big boys club to be able to access this asset class. Next is going to be real estate. There's plenty of great real estate assets around the world. As an average investor around the world, you can't access this. It's very hard for you to come in and out or any of this asset class.
And really, most
Yeah.
of the countries of the world have electronic trading platforms now.
That's right.
Most of them do.
Yep.
But they have, a paucity assets. All you're stuck with is these commodities of
That's right.
coins, right?
That's right.
And so there'll be an injection of real asset-backed private securities up on these electronic platforms. And it'll be like NASDAQ or like the New York Stock Exchange. And then you'll look, well, who's the underwriting bank? Who are the lawyers on the
auditor,
cover? Is this really safe? Who are the managers? Are they real guys? You're going to be able to do that diligence and go, well, all right, it seems like a safe investment. Those guys have a track record, and I'll eventually get my money. And so there'll be a whole class of kind of a private marketplace for that'll move down to accredited investor class at least. That's how we see it.
Do you think the Mt. Gox problem and other similar hackings have set that back a little bit?
I can take a cut of that.
Yeah, go ahead.
Yeah,
It's a good question.
I mean,
I haven't thought about that.
in most cases, we keep a whitelist of all investors, so we know who is the last purchaser of this, and if there is a theft, and somebody reported a theft, we have to acknowledge the transfer of these shares just like a regular, and we can track it down and stop that theft from, we block it.
Also, Mt. Gox, were they a trading platform? Or were
Yeah,
they-
they're trading.
So were they a
yeah.
licensed ATS?
No.
Yeah. So that's the other thing
That's
is
the problem.
is the regulators
There's
are
no
coming
whitelisting,
into
yeah.
to the marketplaces.
Exactly.
And so you're only going to deal with
Yeah.
the level of market that has security and their registered alternative trading systems
Yeah.
where these things are listed. You're not going to the off-brand marketplaces. You're not going to list them.
So that's like a jamboree of software engineers.
Yeah,
Yeah,
it's-
yeah.
those other ones,
So
exchanges can be very
All the
risky.
hacks happen at exchanges. It never happen at the core of the technology. The blockchain technology
Oh,
is
right.
extremely safe. Yeah.
The
And as long
technology
as you
for-
keep the whitelisting, you're fine.
Yeah. But it's just that some,
Of course,
you
of course.
know, the
Exchanges
new
is a
investors
problem.
that don't know, they don't realize that
Yeah.
these unregulated exchanges are very risky in that, if you're
That's right.
trading, if you've got an account with Schwab or Fidelity or something like that,
Yeah.
there's an equivalent of the FDIC
Of
where
course.
your securities are actually insured. So if
That's
anything
right.
happens, you're protected.
Yeah,
But at these unregulated exchanges,
yeah,
you're screwed
yeah.
if anything happens to
But
them.
you seeing a lot of more of these insured, like with the custodian services of your digital coins. There's like 2-3 custodian services that are fully insured today. You can really they can park your coin into hard wallets and they're insured for you. So you're pretty safe until you cash them out.
Oh, I believe. I think that problems like this are just part of the growing pains.
Exactly,
And it's kind of like
absolutely.
you succeed by failing
Yeah.
idea, where people learn from these problems.
That's right.
I have a question. I'm just learning about, the blockchain, and,
Yeah.
I followed it, but my question is, you talk so much about asset, but just like you have a white list of investors, doesn't it start with the valuation?
Yes.
So is there a white list of who's, valuing?
Yes.
Like,
Yeah,
in
right.
Silicon Valley, and you go to the startup, like I'm
Yes, yes, absolutely.
Right now,
So,
and they're looking for funding, and so they're deciding what their valuation
Yeah.
is, and the valuation is based on partly a product, but they're actually providing a service, and so that's
Yeah.
not really an asset. So the asset is how many eyeballs or hits they're gonna get.
Yeah.
They're gonna get 10 million views.
Yeah.
Is that an asset? Is that what you're talking about?
Well, I think one thing, I think we need to make a distinction. We need to separate
exactly. early
blockchain
stage.
and tokenized securities
That's right.
from early stage companies.
That's right.
There's no
That's
correlation
right.
there.
Yeah.
Early stage companies can use that vehicle, but later stage companies can also do it. So when we say blockchain, everybody thinks startup. No,
Yeah, it's not.
it's they're not related.
But when you gave the example of Spotify, for
Yeah.
example, Spotify is actually a beautiful case study.
Yes.
Because they chose not to be hammered by the VCs, the
That's right.
traditional VCs, taking all of their
That's right.
company.
That's right.
So that is the beauty of what they did.
Yeah.
And then they used what you're describing as alternative, way of investing, so that the little guy could get in.
That's right.
Because they had family and friends and angel, angel family and friends.
That's right.
Well, hold on. They were in the beginning. They were early stage startup, so they were kind of a risky idea to make it happen. But later on, they were a blue chip
Yeah.
And the VCs
technology company, right?
But later on,
they were a
only-
blue chip company. They were no longer a startup.
Let me take a cut on
The
this.
venture capital people were in that.
So,
at
yeah.
that point.
Yeah.
So,
So there's a gap between the angels and the VCs.
yeah. Once you get to a C round or even a B round, these companies, they do quarterly valuation by an independent accounting firm, okay? And there is one that's very specifically that controls most of these valuations out there. These valuations are very consistent, and they really drive, what the market is for these companies. So,
I
these,
don't agree.
I
don't agree.
I,
The issue is the valuation is based on a pro forma, and the pro forma on an early stage company is nothing but a guess.
it could change, but that's what it's based
But
on.
we're not
Yeah.
discussing early stage companies.
Yeah, exactly. You're discussing a $1 billion company. Early stage, I agree with you. We're not going to be there. Early stage is, I know what's the value in the Silicon Valley.
That is an asset class. It's an asset class.
Yeah.
Early stage.
And we don't touch early stage in our case because it's very hard to evaluate.
Exactly.
Yeah.
You're right, they are valued for their own stock option
Yeah,
purposes,
and that's
but
that's
No,
tough.
I agree with you.
That's
Not
a tough
early stage,
valuation
but if
early
you
stage.
get to C round, the valuation is there, and that's how you issue your stock to your employees, and that's how you sell your shares to secondary.
I have a question coming from myself as a developer of smart
Yeah.
contracts, person who's been trading those things, about the perception of security of the company. Because from my perspective, there's multiple proven attack vectors in blockchains, like several ways to exploit them on the blockchain level as well as on the smart contract level. For example, when you make a token, etc. Right now, the discussion seems to have conflated a little bit the blockchain aspect of the layer with the tokenization. How do you perceive the security on that? And is that something that you care for at the moment? Or is this something that would just take insurance and hope for it?
Absolutely. Day one, even before you print your smart contracts, you have to have, I would call it 50-point security checks that we have to go through. Dual signatures to multiple different computers, off-net. I mean, I cannot give you all my secrets, but every employee in the company has to go through very strict requirements, even with their emails. We've seen people that get hacked by even taking their phones and imitating your voice and calling for you to send a wire using my own voice because they can duplicate your voice. So we're very familiar, and we're putting a lot of this, what I call 50-point security. It's scary out there.
Yeah.
I don't know, but were there any investment bankers involved in the Spotify registration?
You mean the IPO?
Or listing, it was a direct listing.
It was a direct listing?
Raised any money?
They didn't raise it. It was a direct listing.
It was direct.
It's a registration fee.
Yeah.
Yes.
So they provided liquidity for the
That's right.
for the private investors.
That's right.
There was no investment bankers involved.
Nobody.
And the
book-
direct listing, no investment
No.
banks.
So
No
the
book running.
innovation that Spotify represents is disintermediation
That's right.
of the selling process, because the equity was raised in the private market. There may have been.
But
Oh, there were bankers
but there were
involved in that
bankers
part of
involved
it,
on
yeah.
that part, and there was like more than 10 points probably paid on those deals.
But
Ouch.
So no, I mean it's like you can't circumvent the I mean I guess the IPO, it was a direct listing,
Direct
but
list.
the commissions paid on all the trades. I mean,
But what was
who
paid-
knows what the commissions?
paid
Uh-huh.
to the investment banking sector was less than it would have been if it would have been an IPO to raise the capital.
I think that's unknown figures because there are so many secondary trades, and the commissions on those trades are based on spreads between selling price and
ask.
buying price. Yeah, bid and ask. And all those trades were private NDAs, the buyers and sellers. Only the bankers will. I mean, actually, I don't know.
It's not really a banker. It's
So
the corporation that handles it.
No, the bankers were trading the deals.
Well, you make a market for it, right? You have and people call us all the time, and they say, "I've got some Sonos I want to sell."
Yeah.
I go, "All right, I'll find somebody to buy it." Well, I mean, I make a market there, and we're going to make a spread, right? Now, some markets like the New York Stock Exchange, I'm going to buy some Apple. There's not very much money made on
That's
that
right.
transaction, right? You can just go up and
Yeah.
buy it online. But if you make a market, you know, if you're kind of a non-liquid or not very well traded thing, you know, and they say, I want to buy some, I've got a few people that have been asking me about Sonos, so I'll hook it up.
And there are established
Private placement,
trading
it's called.
systems, private trading
Yeah.
systems.
It seems to me that, you know, if it was if there was a raise involved in the investment banker's involvement, it would have been compensated what?
Call it private placement.
Yeah, but
Oh, and if it was a raise, if it was a capital raise for the IPO.
substantially more than it would have been through making a market. So I think the Spotify innovation was that if you can attract a robust amount of private capital, and if you also have a retail presence where registering your shares creates a fairly liquid secondary market, then
Yeah.
I agree with you.
squeeze the investment banking portion.
That's right.
That's the novelty. Not everybody can do that.
Well, yeah, the fact they had a robust secondary market in their securities was a good indicator of how well the public offering would be received. Really good indicators. A really active secondary market, you know, great. So that way we'll just do a direct listing, and they you know, their stock pretty stable value.
Venture capital do that all the time.
Yeah, it was a good indication of what was going to happen,
So 5 years ago, it used to cost between $5 to $7 million to take a company IPO, because you have to have a set of lawyers on the company side, set of lawyers on the banking side, about 3 to 4 million just in legal fees, and then you have all the roadshow and other fees. $7 million very easily.
Yeah,
How many?
since
What
Sarbanes-Oxley.
are banking fees like?
It's pretty hefty. It's
in
like
points?
seven.
So
It's 7% on 100 million raise minimum,
100 million.
and you have to have all the, checks and balances there. So,
I wonder if the
But-
Spotify deal, the bankers make
but
more
s-
money
but
on the
Spotify
secondary.
is very unique. It's a
It's
well-known brand. Everyone loved, performing really well. That's a very rare case.
It's a private IPO.
Yeah, it's a private
Do
IPO.
we know how many stockholders they had before there?
No, I don't know.
I don't really know. I don't know the details on that.
Because once a company has 2,000 stockholders, it used to be
Yeah,
500,
exactly,
but
yeah.
under the Jobs Act, it was increased to 2,000.
2,000, yeah.
Then you have to
File,
register with the
yeah.
SEC anyway.
Yeah.
Yeah.
You don't have to, you don't have to register the shares for resale. But then what's the point? So.
So an important takeaway is you don't want to link a digital
Exactly.
tokenized securities and blockchain with a particular asset class,
That's right.
right? And so because everybody thinks startup, that's not the case. That is a particular asset class. Hadar has an investment fund that invests in very mature early stage
Very
companies.
well valued, very well
you know,
known.
pre-IPO
revenue.
companies, right?
Yeah.
It's a different asset class. And then there's other guys in our pipeline that have a portfolio of high-valued real estate. It's a different asset
That's
class. This kind of blockchain ledger and security token technology is asset class agnostic. So if you have an appetite for early-stage companies, not a bad way to hold your securities. If you're more risk averse, you want later stage growth companies pre-IPO, great way to hold your securities. And if you want a different alternative asset class like a real estate or some equipment leasing or something that's a stable asset class that pays a dividend, digital way is a great way to hold to create that holding. So I think that would be the biggest takeaway I would say is it's asset class agnostic, and early stage startups is a particular asset class. I'm not criticizing. I like, it's important to have a diversified portfolio of interest, right? From, risky to low risk. But I think I think this electronic tokenized securities is a great way to hold your interest in what we call alternative asset classes, which is everything that's not public.
But isn't the cost of raising capital is going up? Almost like, as you said, $6 to $7 million for, I guess, Spotify could afford it. A lot of
That was for an IPO.
That's
We're talking
IPO.
about.
That was the
Since-
old- that's
since
the old
Sarbanes-Oxley
days.
in 2003.
Exactly.
Fees have gone up dramatically. It's often
The
referred
audit
to as
alone
the
is-
Lawyer Job
yeah.
Security Act and the
Yeah.
Accountant Job Security
That's
Act.
right.
And the bank.
asset seems to be a much more
Efficient.
efficient and cheaper way.
Absolutely.
It's based on capital for your startup and not lose liquidity, not lose, stake in your company, right? So in that case, we need probably some boutique lawyers. Where would the investment banks, people that are venture firms, how would they participate in this?
Well, you still need to design the security, right? So if you do a do-it-yourself raise, maybe early is okay, but as soon as you get to a little bit of growth stage, you really need to get some professionals to help you design the security, because you're anticipating maybe you're going to have an active secondary market and things like that. So you need the lawyers and the bankers to help out with that a little bit. Otherwise, you're going to get an awkward structure that no one's going to want to buy later.
It really is a case of an ounce of prevention.
Yeah.
I can't tell you how many times startups have come to me where they've already done a bunch of stuff on their own and they've made a bunch of mistakes. Sometimes they can be fixed, sometimes they can't.
That's the reason you get paid all the money.
Well, true, but now I was in a meeting today with lawyers. I won't name the firm, but it was like a top 3 in the world firm, right? And I said, well, how you guys doing? And he says, we're pretty busy. And I said, what are you doing? He says, well, primarily we're dealing with subpoenas on ICOs. I go, wow, it's just like really busy with that.
And we're joking. It's like, you make the trash, you clean the trash.
That's right. So you go to your attorneys first, and they design your ICO, and then you pay them to keep you out of jail. But that's why it's good to have the bankers and the attorneys work together, because we're more versed with the securities law and sale, while the attorney is also a securities attorney. So it's good to work together. And
Or versus the market.
yeah, so
But the market
it's
would-
good to have both people at
Yeah.
the table, really, and don't bring us in last. It's expensive. Yes?
So in the crypto assets industry, we often hear the phrase institutions are waiting to get in. It's been thrown around a lot. Institutions are looking, they're waiting, they're not getting in. And like we know the reasons why. Like it's opaque, it's unpredictable, it's non-compliant,
That's
it's
a good
super
question.
confusing, too new to understand. But when I think about it, I think, well, institutions are waiting to get in. That means they want to get in. So let's flip this negative narrative for a minute, and can you each give one of your top reasons, given the current market conditions, why do you want to get in tokenized securities?
Well, people won't do what they don't understand.
But why interested? We know that.
Because the opportunity for liquidity in alternative investments where none exists today. That's the interesting thing about it.
So let me take
Should I say that again?
Yeah.
You get that? You're in an alternative investment. Generally, it's a long walk. It's not liquid, and to make it liquid is an awkward, expensive transaction. The offer or the proposition for electronic securities and trading platforms is for really nice assets. There's the opportunity for liquidity in alternative and private, and that's why it's interesting.
Any other perspective?
Yeah, let me give you my view on this from meeting with like 500 of these guys that you're talking about. It basically comes to one thing. a good product they can sell, and they can put their name and reputation behind it. If you look at the service providers that I had to negotiate with, there's certain things called reputational committees that we had to get approval from, like the top auditor on our firm. It took 6 months to get a reputational committee to approve this new thing called the blockchain, although it's of the highest standard. So at the end, if you give them a quality product that is well audited, well
Well, who are
governed,
your
well
auditors?
lauded.
Are Deloitte?
Yeah,
right?
Deloitte. Yeah, in this case, it's why they will say no. They need the track record, which the team does have, and they need a quality product. The problem is 90% of the products out there are not quality. They're trash. They're failing.
90. That's a high.
I know. It is 90.
That's low. That's a
And
low
this is
estimate.
why,
yeah.
you know,
stock bankers
this,
before that?
That's a low
but
estimate.
the technology is amazing. Technology is here to stay. It's going to improve over time. I think, do you see a convergence, back to your questions in the back, between all these offerings and all these products that at the end it should really converge and combine? I think 20 years from now, you're not going to see an early stage, a mid stage, a between stage, and then an IPO, and then post IPO. This really should be one product, and it's going to be on the blockchain. And you really don't need all this banker fees and lawyer fees. It's going to tame down, and the guy who's going to benefit the most is the consumer. As long as we keep it clean, guys, this transition to having a clean, transparent, well-governed, has to happen before this will become really something.
Well, let me
acceptable.
elaborate on
Yeah.
Deloitte for a minute before
Yeah.
I get there.
Yeah.
I want to say, look, he spent a lot of time and money getting Deloitte to get their head around how nice his offering is.
That's right.
Because as
That's
a
right.
buyer, you're going to go, I'm thinking about a token, I'm thinking about a security token, but what's the value really? And you're going to look at that and well, Deloitte says it's worth $10,000, that piece. And you're going to go, well, I like Hadar, but I do trust Deloitte.
Yeah.
So I kind of get the fact it might be worth 10 grand. So you feel good about that. These are the kind of reputational issues you're going to start looking at in the marketplace. Go, well, who are the auditors on it? Who are the bankers? Who's the counsel on the deal? Well, those guys, they have reputation, and then they have regulatory pressure not to cheat you. So you'll feel a little more comfortable making the acquisition. Then you have to make the decision, okay, I'm not going to get cheated. Now I have to make an investment decision, but am I going to make money on that? But that's your decision.
But
But at least you can know I'm not going to get cheated.
to reiterate both,
Right?
both
Does that-
their points, yeah, to your point, the investors are waiting, the institutions, because the institutions' stakeholders, they don't have going concern risk. While the stakeholders on the technology suppliers to these
That's right.
to the blockchain technology, there is going concern risk. Those suppliers are startups. They're early stage. The whole ecosystem is pretty early stage. Therefore, the investors are primarily speculators. They're not the CalPERS or you see BlackRock, he's just laughs about anything blockchain. He's like, not yet. Because the stakeholders he knows, the ecosystem of suppliers, there's going concern risk.
But
So until
That's
that's
that.
eliminated,
It has happened.
NASDAQ?
Yeah,
What are they
NASDAQ is in it, guys.
just now.
No, I know they've been working on it, and
They've
it's
been
going to
working
happen.
on it
Yeah,
because it's.
I tell you, everyone is working on this.
And us,
Everyone.
as a group, as a partnership at our firm, we've been in research and development on this for 3 years now.
And we don't have one subpoena from ICO. Because we knew.
Yeah.
We looked at, people came to us with that and says, there is no way we're going to touch that thing.
Is there an accounting firm that's given an opinion on no risk?
I don't think. an
Well,
accounting firm would
excuse
do
me,
that.
nobody's going to give an opinion on no risk.
But they'll give
except-
evaluation and
except
audit.
the Treasury Department.
Yeah,
the
even
only,
that.
the
depends who
only
you talk to.
risk-free is Treasury bills. So let's just.
Depends who you-
I would not have taken this project to market if I didn't have a
Yeah.
tier 1 auditor on it. It's not worth
Yeah.
it. Yeah.
Oh, I'm sorry, go ahead.
Yes, from a startup viewpoint, I'm from a startup called Maculus Therapeutics here in the Bay Area. We are in the fundraising process. We just started, so we are looking at angel round. So for us, how can we make use of it? Primarily the concern is, since we're talking about the valuation and the projection of your potential, all that is highly speculative in our case. So how can we make use of the tokenized security for fundraising?
Well, I have your offering, I have your offering docs kind of digitally compliant,
Yeah.
right? And the price of having a, secured token on the blockchain to keep track of your cap chart is going down. So if you're like digitally ready, so you may be just friends and family and it's all paper stock certificates and things like that. But if you think on the next round, if you're thinking that we're digital ready, that will help the value a little bit because it'll be easier to hold and easier to buy and easier to trade in the secondary market before you go IPO. So,
I'm just gonna, it seems to me that there's a good market opportunity for you bankers. And that is in compliance and working with early stage companies, not an angel round. But when the angel round is done and they have to go for a B round, a banker should be involved.
well, like what do we always bore my staff with the same story? I said, we like to be the smartest guys in a room, so we just pick a room nobody's in yet.
Yeah. Let me add to that. The myth it costs. Let me add to it. The myth that it costs very little money to do an ICO may be true, but it's not true.
It's not.
It costs over $1 million to do a good ICO. Between marketing, legal, all of that. It's very costly, and I don't recommend it for a startup. There's other ways to do crowdfunding and angel, and you live in this area. There's other methods than doing an ICO. I highly don't recommend it.
But what I said, I didn't say do the ICO. I said when you look at the docs, just think in terms of it may be digital someday. So
Yeah.
think about voting
I agree with
rights.
you, yeah.
Think about things of that nature. Think about ability to trade in a secondary
Yeah.
market without too much friction. And so that's not too difficult to put that in the documents so that you're kind of digitally ready because it is expensive. Hadar spent a lot of money forming this thing, and so it is expensive to do. But think in terms of we're
Yep.
digitally ready, and
Exactly.
do I want
I like that.
do I
I
want
like
common shares that don't have much voting, but we're going to allow free trading?
Yeah.
Right? Am I going to have pref shares that have high voting rights that don't trade? Things like that.
That's why you have a good attorney.
Yeah.
Yeah, and a banker to put his 2 cents.
That's
worth.
true. Yeah. You still need the whole thing.
There is no banker.
No, but there isn't at an early stage, not at that stage.
When you say digitally ready, could you just elaborate?
Well, I just mean the classes of shares and
Yeah.
the rights of voting rights and things like that around the shares. But think in terms of if you have a lot of shares trading in the digital marketplace in the secondary and they have voting rights, your competitor buys them up cheap and all of a sudden he's controlling your company. You see? You say, well, okay, how about the freely trading shares have minimal, like Zuckerberg wish he did. Had minimum voting rights, but they have free trading rights. So that way none of your competitors can like buy them up when they're cheap and hammer you, right? So just think a little bit like that. Pref, common, voting rights. Not zero voting rights, but maybe diluted voting rights.
I think that kind of shows that companies need people to actually understand the technology and some of the basic background. Don't need to have as much knowledge as a lawyer or a
That's
banker.
right. That's right.
But if you really don't know what's going on, I mean, you don't want to use this technology if you don't really grasp how it's going to work. what the
Unintended consequences you don't want.
That's
Yeah.
right.
It's unintended consequences. And it's hard to switch later. I mean, Zuckerberg tried to switch the voting rights in his stock, right? And then big investor lawsuit, he walked away from it. But again, it's because these marketplaces anticipated public offerings earlier, and they didn't realize the robust private sector. Now we know that private is kind of a long world. It's a long gestation period, and there's secondary liquidity in that marketplace now. So we have to think a little more carefully about the share rights, thinking in terms of an active private secondary market.
So basically what Jeff is saying, you can take the same rules you have for your standard paperwork and put it on the blockchain and make it ready under smart contracts in case you want to put it on global exchanges for two reasons. Create liquidity for your internal investors, and two, create additional fundraising. So you can move to the digital blockchain world much faster. But I don't believe in this case you really need it for
Not
your
early
initial
stage.
funds. It's cost item, you don't need to worry about it right now. I would suggest you go the traditional way early on and then figure it later on when you need it.
Any more provocative questions? That was a good one. That was a good one. That one.
What do you foresee happening to the typical 2 and 20 fee structure for funds as we get these tokenized securities?
Ouch. I expected that. But
I asked for it. I asked for it.
Good
Bring them
question.
on.
I always ask for 3 and 20.
You want to take it, or you want me to take that?
Well, I mean, tokenization.
We can have
is,
two
wait, hold on,
different
hold on, hold
views.
on. I want to. Tokenization and blockchain is not a function of investment decision making and investment management. So the compensation associated with the 2 and 20 rule is really about investment decision, investment management responsibility, right? Reporting, credibility, track record. It has nothing to do. I mean, blockchain tokenization is a function of liquidity, coverage, marketability.
Yeah.
So,
But you have very good question. Let me answer it. Let me take.
Does everyone understand what he's asking?
Yeah.
about?
Let me
Fund
I see.
structure, fund fees.
Let me take a cut on it.
I see.
Well, you're
Let me
gonna
take a
okay.
cut. Yeah,
Elaborate
go
the question. That's now okay. Now it's
Yeah,
getting.
of course,
what
of
it
course.
means. Some people
So,
don't know.
so let me answer it.
Wait, hold on, I want to hear more of the question.
It's 220 versus 320
No, when
versus
it-
zero.
what-
He wants zero.
Well, let's throw
No, no,
the
no.
asset. Let's throw the registered investment advisors under the bus.
No,
right
hold on. More about the.
What I'm talking about is like you're talking about, you've mentioned multiple times about there's increased liquidity with these tokens now. You've touched a little bit on you can build the regulations and the compliance of those regulations into the tokens.
Yeah.
Mhm.
And
Why not the decision making?
Because it's blockchain. So a lot of the administrative costs associated with these securities are dramatically reduced.
Hold on a minute. Wait, let me add something. Just like the stock exchange.
Right.
That's a
Very
good
low
point.
transaction costs, right? Because a lot of the compliance is built in. So it's, but these are private securities. It's going to be just like the stock market. Transaction costs super low.
So in case you're looking for lower fees for managing these funds, I don't think it will happen immediately. If you look at the highest returns as an investor, the top 10 tier VCs in Silicon Valley, they all charge 3 and 30. And nobody blink of giving them more money. In fact, their newest fund size are in $10 billion each. And they're still waiting list to get into them. And why? It's because their IRR is higher than anything else in the world. Okay?
The fees are worth it.
The fees well worth it. In fact, people even willing to pay more if they can get in. Now, let me take you to this democratized world of the blockchain, right? In this world, you got two kinds of belief. Either you believe the wisdom of the crowd of selecting which are the best performing companies, or the wisdom of the wise, the fund managers. It all depends which one is going to create better IRR. There are certain funds out there, like Swarm, who charge nothing, but they cannot, you need to think about the end of the day is the IRR, right? But the technology will help move to lower fees. But I think at the end of the day, you need to look at the IRR versus the lower fees.
Yeah, I like to give credit.
Yeah.
The technology is definitely lower cost.
I've got a comment, but go ahead.
Yeah.
I was just gonna ask, you've talked a lot about, liquidity, easily, buy, sell, trade for alternative investments that normally did not have that liquidity and sort of baked in as being, good for the token holder, the security holder. What about the company itself? Is there a benefit? Is there an advantage? Is there something? A lot of companies here, especially here in the Valley, the Ubers and the Airbnbs of the world place very heavy-handed restrictions on transferability on their shares so long as the company is remaining private. And because of the amount of money that's in the private markets, they're able to stay private longer and longer and longer. I don't think it's, by the way, a coincidence that the demand for liquidity has happened at about the same time as those heavy-handed restrictions have sort of come into play. But I'm curious about from the company's perspective.
Well, look, an active private market with a higher valuation, if you want to raise more money, you can issue more shares, just like the stock market, right? Your shares are up. You can issue more shares to raise more money for growth or acquisitions. So when you have an active market like that, if that's part of your question. What's the benefit to the issuer, you're asking? Because for the owner, right, you can trade your shares, and if the value goes up, you can make money, right? For the issuer, if your share value goes up, you can issue more shares, or you can create some liquidity for the early investors or for the principals.
So let me take another point, which the lawyers here are very familiar with. The reason why companies mainly, and I used to be one of these companies, why we limit the number of shareholders is because we don't want to be a reporting company until we get to an IPO, okay? And this is the main reason why we don't want me as a CEO or founder of the company with 51% of shares or 50% of shares. I cannot sell it to a few thousand people because it immediately fills a cap table and you're done. You have to be a reporting company.
On that anyway.
Yeah, exactly. That's why the restrictions. But if you move it into a tokenized fund, you can aggregate, these into one fund, and hence the numbers will help the companies. That's one thing. Two, companies want their employees to be happy, and this area is very expensive. I used to have people want to cash $2-3 million to buy a home, to have a new family. If you want to retain employees, you're going to show them a way to make money. They don't have to wait 10 years to get some kind of liquidity. This is why Facebook allowed it. This is why there's Spotify. There is several reasons why companies. But unfortunately, the legal framework today under the current SEC rules doesn't allow that liquidity. And hopefully, with the blockchain, we will get there, and we'll get there very soon.
And I would say that depending on the size of the company, the people that are running the company have large shareholdings as well.
That's
so
right.
it benefits
Exactly.
them as well. I was thinking
Exactly.
stock options as well.
I
but,
agree.
Concentrated risk.
Companies are run by people. The SEC and DOJ often say that they're going to go after the individuals
That's
so
right.
that they don't punish the stockholders of the company. I don't think they've always put their mouth.
I
They
agree.
don't always do what they say, but
I agree.
it's the individuals behind the company. They
So,
stand to benefit.
before I clear the room with portfolio management theory discussion, which I want to address, but I just wanted to recap a little bit that you do want to divorce your thinking from these tokenized securities and a blockchain way of keeping track of them efficiently from a particular asset class, whether it's startup or whether it's a coin. It's really asset class agnostic, and there'll be we haven't seen a variety of asset classes coming into this method to hold the security, but we will, and this is part of the beginning of it. So you'll see a diverse amount of assets held in this manner. So I think that's a big takeaway from here. And the second thing is that as this market matures, there's a couple things you want to look at. One is, what trading platform is it on?
That's right.
Is it a registered trading platform? Is there opportunities for fraud like Mt. Gox, things like that? Or is it run by NASDAQ and it's pretty safe to transact there? They won't guarantee you're going to make money on the investment, but pretty much they're going to guarantee you're not going to get defrauded.
Yeah.
Then the next thing is to look at is, well, what about the asset itself, the security itself? Who are the players? Is it Deloitte? Is it a top firm like Squire that's underwriting the deal? Is an investment bank with not a bad red flag background? So who are the players there? Who are the principals? Who are the principals? Do they check out in background? No bad actors. So those are the things you'll look for. And what's the asset class itself? So you look at all the players at the table. Well, they look okay. And then you say, well, what's the asset class itself? Can I understand it? Is it a robust asset class? Is it valued in a way that is easy to understand and reliable? And then once you have all that, then you say, well, as an investor, do I like that asset class? Do I think I will make money there? Because I'm not going to get defrauded. There's no back actors. The transaction will be okay on the platform. And then you get down to the real decision that an investor will make is, do I like Manhattan real estate? I think it's going to go up. Do I like growth stage Silicon Valley companies? I go, they've done really well over the years. So then you can take all the noise out of the transaction and just look at the asset itself and say, do I believe in that investment? Is that something I want to allocate to? And this is where we want to get to. This is where these are the things we're willing to participate in, where you can take the concern away and you can just look at the investor and you go, I don't like Manhattan real estate. I would never invest in it. Well, you wouldn't want to do it electronically, then, would you? You see, and this is where the market is going. And then we'll get into portfolio theory,
Yeah.
portfolio management theory, the 2 and 20.
But all this tokenized security that you guys are talking about, what would be the reason for some of these companies to go IPO then?
And that's why.
Here's the answer to that is in the tokenized securities, and especially the private offerings like this, many times they're limited to accredited investors, that have $1 million worth of investable assets or a trailing income of about $250,000, right? Well, the reason to go IPO is it becomes available for retail
You have to
investors.
file an S1, you change your class of investment.
Yeah, so now all of a sudden this liquidity marketplace
That's
that
right.
got bigger,
Yeah.
a lot of more people can participate in the electronic private securities, but it's still limited to the rich guys, right?
But I tell you, 10, 20 years from now, this divide will go away, I believe, from technology.
But then,
point
so
of
you
view.
go
Yeah.
IPO, then now you can, retirement money or non-rich
That's
people
right.
can invest in the asset class. So there's still going to be an impetus to be a public security, for that reason, for the
It's a
investment.
different filing
It's a,
today.
it's a different, it's a different investor
Yeah, class,
pool.
yeah.
It's a larger pool. It's a much larger pool, right? You got retail and you
Retail
got all
and-
the other guys. And this is a little smaller pool.
Will SEC keep on coming into to tokenize or
Oh, yeah.
then
Oh, yeah.
would the exchanges like Kraken and Coinbase and all these,
They're-
do you anticipate they'll basically go away and replace?
No, they'll be regulated.
They
They're
will be
already, they're
regulated.
already bought
believe
ATSs.
Coinbase
They'll
already
be
bought-
fully
yeah.
regulated.
Yeah, they're buying
They're buying up regulated. entities.
regulated
Let's
entities.
remember the SEC.
Ran by
they act-
compliance officers that could go to jail.
That's right.
Not by
Remember,
robots.
the SEC has created a new trading system platform called an alternative trading system.
That's right, ATS.
That is a fully regulated trading platform that you need to be licensed and you need to get approval to run a platform like that. And it's SEC under SEC supervision. So
And you need 2 humans to be responsible for
Yeah.
it.
Yeah,
so those humans are.
So you're gonna
compliance
see the
guys.
guys like Coinbase with
Yeah.
extremely large number of wallets competing with NASDAQ, with
Yep.
no digital wallets, but extremely great reputation of running exchanges. And you're gonna see the competition kick in very, very soon.
But that ATS, the alternative trading system, is a regulated platform. So there's a certain degree of safety from that.
They're all,
A lot
yeah,
of
have
safety.
to be regulated, yeah.
Yeah, ATS.
And so it's regulated, but it's still private
Yeah.
for the foreseeable future. So do you see involvement with rating agencies at some point of time, like for large insurance investors, et cetera?
So
Rating
you're
agencies
asking,
will come in and start looking at this as a-
Coverage.
well, your
a
question
class of-
is that these private alternative securities,
Correct.
like, are they going to have ratings? You can get ratings now for
Oh, you
private
can.
securities.
And
Yeah,
who's-
they'll,
and who's primarily?
S&P.
S&P.
S&P will
Yeah.
do a rating.
They'll do
They'll do a review.
Okay.
And then also you have to look at the auditors, and the auditors will give a valuation.
Yeah, but I meant more for reporting purposes, like if I'm an insurance company and I own it as an alternative investment. So I'm looking to either S&P or.
Yeah, well, it's triple B or B plus. But S&P, will they actually give a rating to a private
I
security?
think they do reviews.
But they'll do a review. There's no rating yet. We've been talking to them. They've been in our office, but they'll do a review, but they won't give it a B,
But I would think
triple
at
B.
some point in time, if there's enough momentum behind it, and it becomes an attractive enough asset class that there would be some interest at some point in time, maybe 20 years.
Yeah,
If there's demand for it.
Yeah, no, absolutely, I would think there would.
This kind of backs into our room clearing portfolio management theory.
Sorry.
Because this is where, because there are no ratings, then you look at a portfolio manager, like we manage some portfolios, right? And you look at the manager, or Hadar manages a portfolio of growth companies, right? So you rely on them to have a valuation from Deloitte and all these pulleys all together. So it becomes a kind of a quasi rating by the manager, and that's why they make points. But when it's a public company, rated by S&P as triple B, the value of a manager putting together a portfolio is very low value, and so the asset management and the fees around that are very low because there's very little value to that.
That's right.
But in private securities, there's not such a mature market evaluation, so then the manager themselves and their track record and their criteria for bringing people in, that's where the value, there's a little bit of value, and they're going to charge a little bit for that management. And so I think that's a good value spend to have a professional manager in these unrated securities, these private securities. But eventually they may get formal ratings, and the value of the manager may be diminished over time. Because, well, I'm only doing private securities that are BBB. Okay, because S&P says, although S&P didn't do a great job during the stock market crash, but
That's right.
so.
So, I probably know the answer to this question, but have you guys done any funds that are involved in impact assets, social impact, or, because that is, I advise a lot of clients who are really interested in getting into that area. They're willing to go for a lower, and I'm not a wealth advisor, by the way, I'm just saying it just about.
Lower hurdle rate.
I'm a
Yeah.
philanthropic advisor, and so, so they're willing to take the lower rate for a longer term investment, but a lot of these investments are, they have a social component that's.
I understand. Are they interested in a fund structure or an allocation to a social impact investment?
Well, in fact, what some have been asking is like a mixed portfolio. If you are doing a mixed portfolio, that some of the investments would be socially responsible investments or social impact mixed with, they want it all, but they want to feel good, but they also want profits.
No, I get that. So the issue with around funds is there's value in, what's the fund theory? Give me your money and I'll make all the decisions what I do with it. People go, well, I don't know about that, right? So on certain asset classes, like I want to get into Silicon Valley growth companies, you don't have any choice. You've got to go with a strong fund manager to compile a portfolio for that asset class. Hadar's a great example of that. You're if you want to be in that asset class, you're going to have to get in a fund. But you get an impact, there are a lot of deal by deals. You can construct your own portfolio based on opportunities that meet your particular investment criteria, or you can get in a fund. And I think there's a lot more opportunities for co-invest or individual investment into particular impact investments that an investor would like or an advisor would like.
The only reason why I bring it up is that, for example, Branson invests in BVI, when you brought up BVI.
Yeah.
I mean, he's a big impact investor.
So let me add to this. The reason I'm doing this, instead of building technology companies, which I spent 20 years doing, is because what we're doing is very impactful. Okay, we're taking an asset classes that are not available to average investors worldwide, and using technology to make them abundant and reachable to these guys. This is why we're doing this, and this is very unique to what we're doing, and we're doing it at the highest quality.
And the token technology
and the token
enables
technology,
you to do
yeah.
that.
And this is what we're doing. We're democratizing investment in venture capital. I make it available to investors wherever it's permitted.
Yeah,
I think that's
you're
very
stuck with
impactful.
with the manager because you can't write a check into Lyft.
That's right.
So you're kind of stuck with a manager, but it's pretty modest fees compared to the secondary.
We're creating
sales.
the basket of the best 20, 30 of these companies.
So if you're interested in that asset class as part of your portfolio, that's a way to participate in it. And you didn't have that option before. So you're kind of stuck with T-bills and public securities or startups. But here's a late stage, growth stage, where the venture guys make a lot of money. Now it's accessible for a smaller allocation of your portfolio. So, but we probably we got about 30%
I
loss.
think the garage closes at 8:30.
Okay.
Seriously, so
But not bad
if anyone is
attrition.
parked in the garage, you're gonna want to get.
What's the,
Go ahead.
well, last question.
Backed
Huh?
securities tokenized yet?
Huh?
Credit-backed securities.
Credit backed?
Yeah.
I don't
It
know.
sounds like he's mostly been talking about equities.
I haven't heard.
I'm not sure.
Look, watch this page. We'll have.
A year
it.
from now. We're working on it.
It won't be years.
Watch
We'll
this
have
page.
it.
Under
We're working on it.
construction.
Under construction.
Yeah.
I love credit,
Yeah.
and we'll have something. So keep an eye on this page. Because I think it's great. I think it's
I like it,
important.
yeah.
Any other questions or?
No, I think that's it. I mean,
Hey, thanks very much
this
for
is
coming.
great.
Really
Thank you,
appreciate it. We
guys.
went over
Good
a little
questions.
bit.
Really good.
Really good.
Thank you.
Thank you.